We have now looked at how to perform a valuation using PE multiples. Next, we are going to look at the calculation using the market value of invested capital over earnings before interest, tax, depreciation, and amortization. So we have already looked at a basic example of how this multiple works. Now we're going to look at it in more detail. So once again, I've broken the calculation down into steps, but I want you to understand the logic behind the steps instead of just studying steps. So how do we calculate the value when using this multiple? We take our maintainable earnings before interest, tax, depreciation, and amortization, and we multiply by our adjusted market value of invested capital over earnings before interest, tax, depreciation, and amortization, and that is the multiple. So in step 1, we are going to calculate our maintainable earnings before interest, tax, depreciation, and amortization. In step 2, we are going to calculate our adjusted multiple. And in step 3, we are going to wrap everything up and calculate our value. So that's the logic behind where those steps come from. Now this method is gaining popularity because it is less sensitive to differences in gearing, effective tax rates, and depreciation policies. And this is obviously because we are using earnings before interest, tax, depreciation, and amortization in our calculations. So guys, let's go to the example, then I'll work through these steps as we go through the example. The following information relates to Jackson Pty Limited for the year ended 30 June. You've been given their actual maintainable earnings before interest, tax, depreciation, and amortization, and you've also been given the forecast information for 20X7. Jackson Pty Limited is a small family-run business. They have a gearing ratio of 30%. The current market value of debt is 3 million rand, and non-operating assets have been valued at 150,000 rand. The forward multiple of a similar listed company is 8. So please note, guys, if they are giving you a forward multiple, this is a future multiple. And we are also told that this is reflective of a controlling shareholding. So that means when I get the value of equity, that value is going to reflect control. We are also told that the similar listed company has a gearing ratio of 40%. So we can see there's a difference in the level of gearing that these companies have. Jackson Pty Limited only has 30% debt in their capital structure, whereas the similar listed company has 40% debt in their capital structure. So we've got a difference in gearing. Calculate the market value of a 20% shareholding in Jackson Pty Limited. So if we are valuing a 20% shareholding, that means we are valuing a minority interest. So let's go back to our steps. In step 1, we need to calculate maintainable earnings before interest, tax, depreciation, and amortization. So please note, your calculation is very similar to what we looked at with PE multiples. You are still going to use the information provided in the question to determine how many columns or how many years you should have in your calculation. If they give you 3 years of information, you are going to perform this calculation for all 3 years. If they give you 4 years of information, you perform the calculation over a period of 4 years. But you also use all of the years provided in the question. And we are also going to make exactly the same adjustments that we made when we were calculating maintainable earnings. If there's anything unusual or once-off or exceptional, exclude it. If there's anything that's not market-related, adjust the expense or the income so that it is market-related. We make exactly the same adjustments so that we can calculate earnings before interest, tax, depreciation, and amortization that is going to be maintainable in the future. Then we've got all of the years of information. If we have an increasing or a decreasing trend, we are going to use the latest figure as our maintainable earnings. If there is no clear trend, we are going to calculate a weighted average. So that is exactly the same as what we saw when we were performing the calculation using price earnings multiples. The only difference between price earnings multiples and market value of invested capital over earnings before interest, tax, depreciation, and amortization is you are now not using earnings after interest and tax. Your earnings are now obviously earnings before interest, tax, depreciation, and amortization. That is the only difference in your calculation. So let's perform step 1 for the example that I provided you with. We've got 2 years of information. We've got the actual for 20x6 and we have forecast information for 20x7. However, we don't have to make any adjustments because we've been told that this is already my maintainable earnings before interest, tax, depreciation, and amortization. So this is after adjustments. How do I know it's after adjustments? Because of this word maintainable. If they just said earnings before interest, tax, depreciation, and amortization, I would need to make all of the adjustments so that I can come down to the maintainable figure. Then once I have the maintainable figure, I need to decide what I'm going to use in my calculation. Now please note, I said to you, your earnings must always be comparable to the multiple. And we've been given a forward or a future multiple of a similar listed company. So if we are using a forward multiple in our calculation, that means we should use forecast or future earnings in our calculation as well. So for step 1, we've been given a forward multiple of a similar listed company. So our earnings before interest, tax, depreciation, and amortization and the multiple must be comparable. So we are going to use the forecast earnings of 920,000 Rand in our calculation. The forecast information for 20x7. Then go back to the framework. In step 2, we need to calculate our adjusted multiple. So either they are going to give you the multiple of a similar listed company or you need to calculate the multiple. If you have to calculate the multiple, the calculation comes directly from the name. We take the market value of invested capital and we divide by earnings before interest, tax, depreciation, and amortization. Please note, if you need to calculate the market value of invested capital, remember that is the fair value of your normal operations. So it's the total firm value, the value of debt plus equity, the total asset value, and we subtract any non-operating assets so that we get the value of our operations. We then need to take the multiple of the similar listed company and we need to adjust for entity level differences. So the same entity level differences that we adjusted for with our PE multiple, we also need to make these adjustments. And the same logic applies because we are still working with a multiple. If the company that we are valuing is more risky, then the value should drop. So if we want the value to drop, we need to adjust the multiple downwards. If the company that we are valuing is less risky, then the company value should increase. And if we want the value to increase, that means the multiple needs to be adjusted upwards. Now, please note, this is extremely important. we are using earnings before interest, tax, depreciation, and amortization in our calculations. So we should not adjust for differences in gearing or the level of borrowings, because both the numerator and the denominator are not affected by financial gearing. So in our example, we were given the different capital structures of the two companies. Jackson Pty Limited has 30% debt in their capital structure, whereas the similar listed company has 40%. But we are not going to adjust for that difference because we are working with earnings before interest, tax, depreciation, and amortization. In this example, we don't need to calculate the multiple because we were given the multiple of a similar listed company. So that is the starting point in my calculation. And we are now going to adjust for our entity level differences. So first, level of gearing or the level of borrowing, we were given the information, but we are not going to make the adjustment because we are not using price earnings multiples. We are using the market value of invested capital over earnings before interest, tax, depreciation, and amortization. We were not given information about the level of competition, the age of non-current assets, or country risk. However, we are valuing Jackson Pty Limited, a small family-run business. So we know that the company is going to be smaller than the similar listed company. So we do need to adjust for this. If the company is smaller, they are more risky, meaning that we need to decrease the multiple. So you can see I'm just decreasing the multiple over here by 1. Then access to finance. Once again, Jackson is going to have limited access to finance because they are not listed. That increases the risk, and we need to decrease the multiple. Reliance on a small number of key employees. This one is also going to be applicable. We are specifically told they are a small family-run business. So they are going to be reliant on a small number of key employees. That obviously increases their risk, so we need to decrease the multiple. Diversity of product ranges, no information. Any other differences mentioned in the question, no information. Differences in future growth expectations, no information. So we can't make any other adjustments. That brings us down to an adjusted multiple of 5. So we've got our maintainable earnings before interest, tax, depreciation, and amortization. We've got our adjusted multiple. We can now bring everything together and calculate our value. So that is step 3 of my calculation. Please note, when I use maintainable earnings before interest, tax, depreciation, and amortization from step 1, and I multiply that by the adjusted multiple from step 2, that does not give me the value of equity, because when I calculate this multiple, I do not use equity in performing the calculation. Instead, I use the market value of invested capital. So this is going to give me the market value of invested capital. So take your maintainable earnings from step 1, multiply by the adjusted multiple from step 2, and you get your market value of invested capital. We now need to adjust that so that we can get the value of equity. So the market value of invested capital is the market value of my operating assets. So if I want the total value of the company's assets, first I need to add any non-operating assets that are valued separately. That is going to give me my total asset value. and remember that is referred to as the overall firm value. Then I deduct the value of debt, and that will leave me with the value of equity. Because remember, my total assets are made up of debt plus equity. That's why my statement of financial position balances. So if I deduct the value of debt, I will then be left with the value of equity. And we were provided with all of this information in the question. If you go back, the value of debt is 3 million rand, and non-operating assets were valued at 150,000 rand. So you can just include that in your calculation. We then have a fair market value for equity. And after we have the value for equity, we now need to adjust for our owner level or our shareholder premiums and discounts. And the first owner level or shareholder premium or discount that we need to consider is a control premium. So guys, are we valuing a controlling interest in this question? No, we are trying to calculate the value for a 20% shareholding. So we are valuing a minority interest. So we are definitely not going to add a control premium. Are we going to deduct a minority discount? We are valuing a minority interest, but first we need to check whether the value we calculated reflects control or not. Now, we were told above the similar listed company has a multiple of 8, and this is reflective of a controlling shareholding. So that means that the value that we calculated over here reflects control. So that's a problem for us. This value reflects control, but we are not valuing a controlling interest. We are valuing a minority interest. So if this value reflects control, we are going to have to deduct a minority discount so that we can get the value that does not reflect control. Now remember, when we look at minority discounts, the range is anything between 15 and 20%. So I'm deducting 15% in my example over here. And after doing that, I will get the value of a non-controlling interest. So we said it was preferable to use earnings multiples to value a majority shareholding. However, if we are valuing a minority shareholding, we can still use this method. We just need to take a minority discount into account. So that's what we've done over here. This value reflects control, but we are not valuing a controlling interest, so we deduct a minority discount. I just want to go back to where I discussed that with you in the lecture notes. When we first spoke about earnings multiples and where the method can be used, it's preferable for a majority valuation, but it can be used for a minority valuation by adjusting for owner level or shareholder differences. So if the value reflects control, but you are valuing a minority shareholding, you are going to deduct a minority discount. Then after the minority discount, we need to consider a marketability discount. So remember, if the shares are more difficult to sell, we need to deduct a marketability discount. Jackson Pty Limited is an unlisted private company, so the shares will be more difficult to sell, so we can deduct a marketability discount of anything between 5 and 15%. So in my example, I'm just using 5%. Then the last shareholder or owner level difference that we need to consider is a BEE lock-in discount. There was no mention in this question, so you don't need to worry about that. Then if we go back to the framework, we've done everything in terms of the framework. We calculated the value of equity. We then took our owner level or our shareholder premiums or discounts into account. And lastly, guys, you just need to multiply by the percentage shareholding that you are valuing. So in this question, we are valuing a 20% interest. So I just need to multiply my final answer by 20%. Then please note, just to wrap this up, I said to you, if you go back in your lecture notes, there are 4 different types of earnings multiples that can be used in order to perform a valuation. We've looked at the price earnings multiple in detail. We've looked at market value of invested capital over earnings before interest, tax, depreciation, and amortization. And these multiples are the most common. However, they can give you any type of multiple, and if you understand the logic that we followed with both of these calculations, you should then be able to perform the same calculation using any other multiple. You just need to remember the whole time, your earnings must be comparable to the multiple. So for example, if you have to perform the calculation using the market value of invested capital over EBIT, or earnings before interest and tax, then because the multiple uses EBIT, you need to calculate maintainable EBIT in step 1. Then you are going to multiply by the adjusted multiple of a similar listed company. So either you're going to calculate the multiple by taking the market value of invested capital and dividing by earnings before interest and tax, or you will be given the multiple in the question. And this must be the adjusted multiple. So once you have the multiple, you need to adjust for entity level differences. Once again, you are not going to adjust for a difference in gearing or a difference in the level of borrowings, because we are using earnings before interest and tax in our calculation. All right, so you be consistent. If they give you the market value of invested capital over earnings before interest, tax, and amortization, then obviously when you are calculating your maintainable earnings, you must calculate earnings before interest, tax, and amortization, because your earnings must be comparable to the multiple. And either you'll be given the multiple of a similar listed company, or you need to perform the calculation by taking the market value of invested capital and dividing by earnings before interest, tax, and amortization. Then once you have that multiple, you go and adjust for your entity level differences. Once again, this is before interest, so don't adjust for differences in gearing or the level of borrowing. So you guys can see, they can give you any multiple in a question. You just need to make sure that your earnings figure is always comparable to the multiple, and then you can perform the calculation. And obviously, when you multiply everything out, the value that you calculate depends on what went into the multiple. So this is going to give me the market value of invested capital. This also gives me the market value of invested capital. That also gives me the market value of invested capital. But this gives me the value of equity.